Welcome. Today we're going to talk about types of traders. All right, a lot of people don't understand what types of traders are out there and available. But think of it as positions on a sports team. There are different type of positions that you can play. And even if you are going to just play one position, you have to be aware of all the positions that are available. So when coming to trading, we want you to know what types of traders there are and which one you may associate with. The first type of trader is what we call the long-term trader, the long-term investor. By default, when you first get into the stock market, that is what you are by default. You come into the stock market and you want to invest in a stock, kind of like a seed. You plant it, watch your investment grow. When I say long-term investment, I say anybody who's willing to hold a stock for more than 6 months to a year or over. So long-term investors are typically looking for companies that aren't as popular, aren't known, and they take the risk of investing in a company because they have a future. So when you look at companies that are established, say Tesla, Microsoft, these are great long-term investment companies, but you also have to understand these companies have already made their big movements up. So there's not much upside to these companies. But what makes them safe in a long-term investment is they don't really go down much. Now, the next type of trader is the most common trader. It's called a swing trader. All right, swing traders are traders that aren't long-term, but they can stay into a stock, for any amount of time, but they don't have long-term plans to be in it. They're just trying to profit out of it. Think of it like dating. You're dating multiple people. You're swinging between people that you may possibly want to invest the time in. Same way with swing traders. I can hold a stock for a couple of days, a couple of weeks, hell, a couple of hours. But at the end of the day, I'm just swinging the stock for a quick profit. It means I'm going to buy into a stock, hold it maybe for a few days, a few weeks, hope to see upward movement, and then I will close my position, sell the stock, and take profits. This is known as a swing trader. So when you hear people say, I'm swinging these stocks, it just means I'm in them maybe for the short term, not too long, but I'm going to move between this stock and another one in a given amount of time. You have the next type of trader, which is called a scalper. Scalpers are very, very short-term traders. What that means is these type of traders like to take a little bit off the top. They don't stay in stocks for very long in fear or risk that the stock price will go down. Typically, when people are scalping, they scalp shares of a company. They may buy hundreds of thousands of shares of a company and watch it move up a very small amount, and then they'll take profit. Let's say a stock goes from $9 to $10, $10 to $11. A scalper would want to get in at the $9 level, watch it go from 9 to 10, 10 to 11, and then take profit. It might go up a little more, and they might jump right back in at 10 to 11 point and continue to profit as the stock moves up in a short period of time. The time frame is based on a trader. It can be minutes, seconds, hours, days, or weeks, but typically this is a very short-term trading style. This eliminates risk of falling very steep, losing a large amount of money or losing a large percentage of a stock. Instead of when you're long-term holding or swinging, you could see movements go up and down. But when a scalper is scalping, they are not trying to catch the downward movement. They're only trying to catch it when it's going up. So it goes from 9 to 10, 10 to 10.50, 10.50 to 11, sell. And then it goes down to about 10.50, goes to 11, 11.50, I jump in. At the 10.50, goes to 12, sell. Very small profits, but it's a safer method of trading, but you have to pay attention to the stock very closely. Then you have one of my favorites, and what I am is what you call a short seller. Short sellers actually make their money when a stock price goes down. I know, you can make money when the stocks fall. Yes, when the stock price goes down. How does short selling work? There are two methods. The most common method is to short a stock by selling put options. If you haven't watched my put option video, I have one available, but you're betting on the stock price to go down. That's the most common way. Then you can short shares of a company. How do you short shares of a company? You have to have a margin account. You borrow shares from your brokerage. The brokerage is Webull, Robinhood, TD, Ameritrade. Once you borrow the shares of the company, you sell those shares into the market, you get a profit, and then you watch the stock go down in price. And when it goes down, you buy back the shares and then you return them to the brokerage that you borrowed them from. If I see a stock that's $10 and I believe the stock price is going to go down, I will go borrow, let's say 10 shares from the brokerage. I will sell those 10 shares. So I've made, if it's a $10 stock and I've borrowed 10 shares, I've made $100. I've sold it, I've made $100. The stock price drops 50%. It's down to $5. I now will buy back those same 10 shares, $50, and I will return those 10 shares to the brokerage and I keep the $50. I made a $50 profit simply by selling the shares, watching them go down and buying them back at a cheaper price. This is known as shorting a stock or short selling. Options. Options traders are traders who pretty much trade options and like to buy calls or puts on a stock. Calls meaning you believe the price is going to go up. Puts meaning the price may go down. First and foremost, options trading is pure gambling. Anyone can tell you anything else, but it is gambling. You are basically betting, making a contract with your brokerage to own 100 shares of a company if they reach the price that you guessed it to be. All right, whether it's being up or down. This is known as options trading. To get more detail, check out my options video. We talk about that in detail and give you a better understanding. Today, we just want you to get a general consensus of what these things mean and what you want to be. Finally would be the dividend traders. Dividends are simply companies that pay out money simply for you holding their stock for a given amount of time. It's almost like a thank you for holding their stock. A lot of companies, a lot of big cap or blue chip companies pay out dividends. Some pay out quarterly, some pay out annually, but basically it's a thank you for holding their stock for a long period of time. Want to understand more about it? Check out the dividends video that we have available here on Patreon as well. In general, these are the 6 types of basic traders that you need to be aware of. Ultimately, if you're going to be a successful trader, you want to be all of these. You have to wear all of these hats, but you identify with one that you prefer. Myself, like I said, I am a short seller, but understand I'm also a long-term investor, a swing trader, a scalper, an options trader, and a dividend trader. And even if I don't want to be those, I have to be aware of each of these positions and what they mean. So with that being said, thank you for watching this video, and we'll see you on the next one.